Hey there, let's talk about the real estate market. It's March 2023 and things aren't really changing, but let's have a recap of what's going on in the market. It turns out that interest rates are going to go up. They are on the rise. It is interesting though, because we watch certain websites and we talk to certain people about rates, and Carl will come into the office and he sits down and the first thing he does is he looks at that website and some days he says, oh, look at that, rates are down today. So it's kind of like when you get on the scale every day when you're on a diet. It really doesn't matter what happens day to day, but it's the aggregate that we're looking at. So what's happening is that inflation is not really going away. Now here's a fun fact. Inflation is always around. Inflation rates, it's normal to have an inflation rate. It usually hovers around 2%. It's when it gets a little bit more out of control that things need to happen in order to control spending. Consumer spending right now is up. People are spending money. That's a good thing for the economy, you would think, except that wages are not keeping pace with the increase in inflation. It doesn't only impact mortgage interest rates, it impacts other interest rates as well. If you're a business and you have a small business loan, if you're a person, you're going to borrow money to buy a car, interest rates impact everything, right? And the rise in interest rates also impacts more than just housing. But housing is a huge part of our economy. And I don't just mean buying and selling houses, but household costs, things that you need in order to maintain your home, supplies and equipment and things for construction, plumbing, everything. There's so many things that get spent in our economy that have to do with housing, and everybody needs to live somewhere. So what's happening is spending has not really been curtailed and inflation is increasing. Prices are going up. Have you been to the store lately to buy a dozen eggs? Prices are going up almost no matter what you're looking to buy. And that's a problem because wages are not going up at the same time. So if expenses keep getting higher and your income is stagnant, that's a big gap and that needs to be addressed. And one of the ways to address that is by making it more difficult or more expensive to borrow the money that you need to do those things that you need to do in order to live. So traditionally, over the last 50 years, interest rates have always moved in unison with the 10-year Treasury yield, and it's typically at about 1.7%. Well, since last January, it's been between 2 and 3%, so the gap is widening, and that is almost like a measure of fear. That's a measure of, okay, what's gonna happen? We need to close that gap, and the only way to close that gap is by raising interest rates as inflation rises. So you would think that rising interest rates would impact buyer activity. And it does on the national level. Here in our service area though, and we're talking Basking Ridge, but really all of New Jersey. There are parts of New Jersey that are a little bit less active than we are right now. And a lot of the buyers, they don't necessarily have to borrow that much money to make their purchase. They have a lot more money down, which means their interest rates are a little bit lower. It means their loans are a little bit smaller. So it doesn't really impact buyer demand. So we are not seeing, even though interest rates are rising, we are not seeing a slowdown in buyer demand. What we are seeing is a pretty serious lack of inventory. There's a couple of reasons for that.
In the years leading up to 2005, we had 4 consecutive years of record-setting new construction numbers. And then we had a recession, and builders stopped building. And then we spent 14 straight years below the 52-year average of number of homes built. That's a pretty significant deficit.
If you look at numbers year to date, it looks like we have more inventory today than we did this time last year. And this is true, we do have more inventory. However, we are still significantly lower than where we were pre-pandemic. 2017, 18, and 19, that was the last time that we had a normal market. 20, 21, 22, and probably into 23, those are not normal markets, nor are they sustainable markets. The number of homes for sale is increasing, but we're 47.4% under where we were the last time we had a normal market. What does this mean for pricing? Pricing forecasts we still are seeing that there will be appreciation in the market. Back in December, the predictions for the coming years had 2023 at a loss of 1.6%. And then it coming back up in 2024, all the way through 2027. I always tell people real estate is a relatively safe investment, and it pretty much appreciates cyclically between 6 and 8% over a 6 to 8 year time period. Even if we depreciate in 2023, we are still so far above where we were before the pandemic. That kind of means something. Here's what it means. This is a pretty incredible number, okay? The potential growth in household equity over the next 5 years, based solely on increased home equity. If you purchase a home in January 2023 for $400,000, projected price appreciation by the Home Price Expectation Survey is $54,296. That's a big number. It's not bad. Real estate appreciates. Prices are not coming down. People who own their homes now have more equity than maybe they even realize. 48% of mortgaged residential properties in the United States were considered equity rich. That means if you own a home and you have a mortgage, you probably have at least 50% of the equity in your home. If you're thinking about moving and you have a loan at 2.5% or 2.75% or 3%, you might be thinking, why would I give that up if I'm going to have higher borrowing costs because interest rates are near 7%? You might not. However, if you're one of those people that has more than 50% equity, and if your plan is to move out of state or somewhere where there's a lower cost of living, or you're downsizing, if you have 50% equity, that means that you can probably put down a big chunk of money, which narrows the amount of money that you need to borrow, which limits your borrowing costs. There's ways to get around a high mortgage. I can pretty much guarantee that their interest rates are going to be less than they are today, but you can always refinance. So as soon as you've built some additional equity into your home, you can refinance for a lower amount, for a lower rate, to eliminate your PMI if that was something that you had to do in order to get into a house. If you have a question about how you can afford a home given that rates are high, please don't hesitate to give us a call. We can help you understand what your financial profile is and how it relates to whether you would qualify for a loan. Don't wait till you find the house of your dreams to find out if you can buy it. Let's get you pre-qualified. Let's get you understanding. Let's get you over the fear of high interest rates. We can do that. If you found this video useful, please share it. Forward the email. Let me know you're sending it to a friend. If you're watching me on YouTube, subscribe to our channel. Click the little bell. You'll be notified every time we post a new video. Property videos, informational videos, and some fun facts. I hope you have a great day. So there you have it. Let's talk about, skipping this part, 2023 year to date. Nope. Mortgage and whether or not, all right, Jared, just use whatever you can because I'm just gonna go. The March market update. Okay.